I've lived through 11 recessions in my lifetime. 11. And here's what nobody tells you. 9 out of 10 investors do exactly the wrong thing when the economy contracts. They panic, they sell, they hide. It's human nature. But here's a truth that has governed every market cycle since markets existed. Recessions are as inevitable as the changing seasons. Winter always comes. The economy breathes in and breathes out. Expansion, contraction, boom, bust. You cannot stop this cycle any more than you can stop the tide from rolling in. Think of it like a forest fire. Now, most people see a forest fire and think only of destruction. And yes, there is destruction. But what happens after? The nutrients return to the soil. New growth emerges. The strongest trees survive, and the ecosystem becomes healthier. Nature doesn't give you a choice about whether fires happen. Your only choice is whether you prepare for them or get consumed by them. See, most people believe recessions are things that happen to them, events they must endure, periods to survive. And that belief, as comforting as it might feel, is precisely backwards. Let me challenge that directly. Recessions are not periods to survive. They're periods to thrive. They're not disasters to hide from. They're opportunities disguised as chaos. The greatest fortunes in American history were not built during boom times. They were built during the busts. The wealth transfer that happens during recessions is staggering, and it always flows in the same direction, from the unprepared to the prepared. I'm not promising you'll survive the next recession. Survival is for people without a plan. I'm promising you can position yourself to come out stronger, wealthier, and more secure than you went in. But only if you understand what I'm about to share with you. Let me take you back to September 2008. The world was ending, or at least that's what everyone believed. Lehman Brothers had just collapsed. The financial system was in free fall. Every single day brought news of another institution teetering on the edge. People who had never experienced real fear in markets were paralyzed. The experts, the professionals, the talking heads on television, they were all saying the same thing. Get out, protect yourself. This could be another Great Depression. I watched portfolio managers with decades of experience freeze completely. Smart people, educated people. But fear is a powerful anesthetic. It numbs your ability to think clearly. On October 16th, 2008, I did something that seemed crazy to almost everyone around me. I wrote an op-ed for the New York Times with a simple title, Buy American, I Am. The market was in absolute free fall, and I was telling people to buy, not someday, not when things settle down, right then, in the middle of the panic. But here's the thing, I wasn't being brave, I was being logical. I was following a principle I'd learned 50 years earlier. Be fearful when others are greedy, and greedy when others are fearful. That's not poetry, that's mathematics. I bought Goldman Sachs at prices that would have seemed impossible just months earlier. I bought General Electric, Dow Chemical, Swiss Re, billions of dollars into companies that everyone else was running away from. What happened? Every single one of those investments performed spectacularly. Not because I'm smarter than other people, but because I understood something fundamental. When good businesses go on sale because of temporary panic, you back up the truck. Think about how irrational this is when you step back. If your favorite store announced a 50% off sale, you'd rush to buy more. But when stocks go on sale for 50% off, people rush to sell the exact same merchandise at half price, and the emotional response completely reverses. That's the opportunity. that emotional reversal, that panic, that's where fortunes get made. Now, I need to be clear about something. Recessions hurt people. Real people lose jobs. Families struggle. Companies fail. I'm not diminishing that suffering, but the difference between those who suffer and those who thrive during recessions comes down to one word: preparation. Here's the first strategy, and it contradicts everything modern finance tells you. Build massive cash reserves. Keep cash, lots of it, more than feels comfortable. Now, I know what the experts say. They'll tell you cash is trash. They'll show you charts proving cash loses purchasing power to inflation. They'll calculate the opportunity cost. And in normal times, they're right. Cash sitting in a bank account earning 1% while inflation runs at 3% is a guaranteed loss of purchasing power. But recessions are not normal times. Cash during a recession becomes the most valuable asset you can hold. It's dry powder. It's ammunition. It's opportunity in physical form. When assets are falling 20, 30, 40%, that cash you've been holding suddenly has 3 times the purchasing power it had a year earlier. The mechanism is simple. In a recession, liquidity dries up. Everyone needs cash. Companies need it to meet payroll. Banks need it to meet withdrawal demands. Investors need it to meet margin calls. And because everyone needs it simultaneously, those who have it can name their price. Without cash reserves, you're forced to watch opportunities pass by. I don't care how smart you are, how good your analysis is. If you don't have cash when assets are cheap, you cannot buy. It's that simple. Here's the specific rule I follow. Keep at least 6 months of expenses in accessible cash. Not invested, not in stocks that you could sell. Actual cash. That's your survival money. That ensures you won't be forced to sell investments at the worst possible time. But here's the second part that most people miss. You need separate investing cash, money specifically set aside to deploy when opportunities arise. For me, that's always been substantial. Berkshire Hathaway has held tens of billions in cash at times, waiting. People criticized us for it. You're losing money to inflation, they said. And then 2008 happened, and we had cash, lots of it, and we put it to work at incredible prices. The critics who complained about our cash in 2007 went silent in 2009. They were too busy trying to survive. Here's the payoff. Cash reserves give you options. Options give you power. Power gives you the ability to act when others cannot. That ability to act when everyone else is frozen is worth far more than the 2 or 3% you might have earned by keeping that cash fully invested. Remember this principle. In bull markets, cash is a drag on returns. In bear markets, cash is the best performing asset. And because you cannot predict exactly when bull markets end and bear markets begin, you must always hold some cash. Strategy number 2, make your shopping list in advance. The mistake most investors make is they wait until the recession starts. Then they try to figure out what to buy. And by that point, panic is set in. Fear clouds judgment. You make emotional decisions instead of analytical ones. You need to know what you're going to buy before prices fall. Not in general terms. Specifically, write it down, study these businesses now while your mind is clear. Here's the context distinction. In normal times, you can take your time analyzing investments. You can wait for the perfect entry point. You can compare dozens of alternatives. But during a recession, you need to act fast. Opportunities can disappear in days or even hours. If you're still doing basic research when prices are falling, you'll miss the best chances. The mechanism here is psychological preparation. When you've already done your homework, when you already understand the business, when you've already decided if this company falls to X price, I'm buying, then execution becomes mechanical. You remove emotion from the equation. Without this preparation, you'll make one of two mistakes. Either you'll freeze, unable to act because you don't trust your analysis under pressure, or you'll chase whatever is falling the most, which is usually falling for good reason. I've learned this lesson watching other investors in every downturn. The ones who did well always had specific companies they'd been watching, waiting for the right price. They knew the businesses inside and out. They'd read the annual reports. They understood the competitive advantages. They'd calculated what the companies were worth. Then when panic hit and prices dropped, they simply executed their plan. Here's my personal system. I keep a list of approximately 20 businesses I call wonderful companies. These are businesses I understand completely. I know their economics. I know their management. I know their competitive position. And I know roughly what they're worth. For each one, I have a price in mind. Not the current price. The price at which I'd back up the truck. Sometimes that price is 30% below the current level. Sometimes it's 50% below. The exact number depends on the business. When recession fears start building, I don't create this list. I already have it. I've been maintaining it for years. All I do is wait for my prices to hit. The payoff is enormous. While others are paralyzed, asking, what should I buy? I'm executing. While they're trying to decide if a company's good or bad, I'm calculating position sizes. Speed creates opportunity. Here's the principle. Preparation replaces panic. The work you do before the crisis determines your performance during the crisis. Let me give you a concrete example of this strategy in action. In 1963, a company called Allied Crude Vegetable Oil Corporation was running a massive fraud. They were claiming to have huge inventories of salad oil stored in tanks in New Jersey and using that oil as collateral for loans. Turned out the tanks were mostly filled with water with just a thin layer of oil on top. When the fraud was discovered, it triggered a financial crisis. And one of the biggest casualties was American Express, because their warehousing subsidiary had issued the receipts used as collateral. American Express's stock crashed. It fell from around $60 to under $40 in a matter of weeks. Panic selling. Everyone assumed the company was finished, that the lawsuits would destroy them. But I've been studying American Express for years. I understood their core business, the charge card and the traveler's check. I knew those businesses were extraordinary. High returns on capital, strong network effects, loyal customers. The salad oil scandal had nothing to do with whether people would use their cards. So I did something simple but powerful. I went to restaurants and watched people pay. I went to stores and counted how many American Express cards I saw. The business was fine. Customers were still using the cards. The franchise was intact. I bought heavily. Somewhere around 40% of my entire portfolio went into American Express. My partners thought I was crazy. The stock was falling every day. The news kept getting worse, but I'd done my homework before the crisis. I knew what I would buy if American Express ever got cheap enough. And when the opportunity came, I acted. Over the next few years, American Express more than tripled. Not because I was lucky, because I'd prepared. That's the power of knowing what you'll buy in advance. Strategy number 3, you must train your mind before the crisis hits. Mark this as a deeper point because it touches on human nature itself. All the preparation in the world means nothing if you cannot execute when the moment arrives. And execution under pressure requires psychological training. Here's the timeless principle. Your mind will betray you when you need it most. Fear is an evolutionary response designed to keep you alive, not to make you wealthy. When markets are crashing, when unemployment is rising, when every news headline screams danger, your brain will tell you to run. That's what it's supposed to do. But Wealth is built by doing the opposite of what feels safe. Think about the extended metaphor of a soldier in combat. A soldier trains for years before seeing battle. They run drills. They practice under simulated stress. They condition their responses. Why? Because they know that in actual combat, they won't have time to think. They need their training to take over. Investing in recessions is the same. You need to train your responses now while markets are calm. I've watched this play out over decades. The connection to human nature is profound. We're wired to follow the crowd. It's how our ancestors survived. If everyone was running from a predator, you ran too. You didn't stop to analyze whether the threat was real. But in markets, the crowd is usually wrong at extremes. When everyone is terrified, that's usually the best time to buy. When everyone is euphoric, that's usually the best time to sell. The multi-decade example I always return to is the Great Depression. The absolute bottom of the market was in 1932. The Dow Jones fell 89% from its peak. Unimaginable devastation. But here's what's remarkable. If you'd bought stocks in 1932 and held them, you would have made spectacular returns. Not in months. It took years. But the wealth creation was enormous. The investors who did that weren't braver than everyone else. They trained themselves to see opportunity where others saw only danger. As Benjamin Graham said, and I quote, "The investor's chief problem, and even his worst enemy, is likely to be himself." That's the authority quote I want you to remember. Your biggest obstacle isn't the market, it's your own psychology. So how do you train yourself? Here's the practical application. Start small. Right now, while markets are relatively stable, practice buying when prices drop. Not huge amounts, but enough that you feel it. When a stock you own falls 15% and you're tempted to sell, buy a little more instead. Train yourself to associate falling prices with opportunity, not danger. Condition that response. Study past recessions. Read the headlines from 2008. Read the headlines from 2000. Go back and read what people were saying in 1974. Immerse yourself in that panic. Then look at what happened next. The pattern is always the same. Panic, capitulation, recovery, growth. Always, without exception, the economy has never failed to recover. Understanding that pattern intellectually is different from believing it emotionally. The payoff for mastering your psychology is the ability to act when action creates wealth. That's not a small thing. That's everything. Strategy number 4, and this is absolute. Never use leverage. I cannot emphasize this enough. Leverage destroys investors during recessions. Not sometimes, always. Here's the destruction mechanism. Leverage forces you to sell at the worst possible time. When you borrow money to invest, you create an obligation that doesn't care about market conditions. The margin call doesn't ask if you'd like to wait for prices to recover. It demands cash immediately. Let me give you the cautionary example that should terrify anyone considering leverage. Long-term capital management. This was a hedge fund run by some of the smartest people in finance, Nobel Prize winners, PhDs in mathematics, decades of experience. Their models were sophisticated. Their analysis was detailed. They were leveraged approximately 25 to 1. In 1998, when Russia defaulted on its debt and markets dislocated, their positions moved against them. Not by a lot, maybe 2 or 3%. But when you're leveraged 25 to 1, a 2% move against you is a 50% loss of capital. They were forced to liquidate everything. Positions they knew would recover, they had to sell. Not because their analysis was wrong, because they couldn't meet margin calls. smart people failing, the smartest people, all because of leverage. Here's the protection rule. Only invest money you won't need for at least 5 years, preferably longer. 10 years is better. If you might need the money sooner, it shouldn't be invested in stocks, period. The safety margin this creates is psychological and financial. Psychologically, you're free to ignore short-term volatility. You're not checking your account every day worrying about margin calls. Financially, you never have to sell when prices are terrible. I've operated this way my entire career. Berkshire Hathaway has never used significant leverage. When people ask why, I tell them, we've seen too many smart people get wiped out. We don't want to be smart and wiped out. We want to be smart and around to invest another day. The principal extraction, leverage amplifies gains in good times and amplifies destruction in bad times. Since you cannot control which times you'll face, the rational response is to avoid it entirely. Strategy number 5, understand real diversification. There's a common misconception about diversification. People think it means owning 500 different stocks, or owning every sector, or owning stocks, bonds, real estate, commodities, and currencies. That's not diversification. That's confusion. The correct definition, diversification means owning a focused collection of businesses you understand across different industries, so that no single event can destroy you. Let me give you multiple examples of what this looks like in practice. Example 1, if you own 10 banks, you're not diversified. You own the same business 10 times. When a banking crisis hits, everything falls together. Example 2, if you own 200 stocks, but you don't understand what most of those companies do, you haven't diversified. You've just admitted you're guessing. Example 3, if you own wonderful businesses across technology, consumer staples, healthcare, utilities, and financial services, and you deeply understand each one, now you're diversified. Why does this difference matter? Because the goal of diversification isn't to own everything. The goal is to ensure that you can sleep at night while still generating good returns. There are the clear criteria I use, approximately 10 to 15 businesses that I understand completely. Each one should be in a different industry. Each one should have strong competitive advantages. Each one should be able to survive a severe recession. The before and after contrast is stark. Before you understand this, you're collecting stocks like baseball cards. After you understand it, you're building a portfolio like an entrepreneur builds a team. Every position has a purpose. Every business solves a specific problem. Now here's the practical application during recessions. Some sectors are defensive, consumer staples, utilities, healthcare. People still need to buy toothpaste and pay electric bills during recessions. These businesses provide stability. Other sectors are cyclical. Industrials, materials, discretionary retail, these get hammered during recessions but bounce back aggressively during recoveries. Smart diversification means holding both types. The defensive holdings generate cash flow and stability. That gives you the confidence to buy cyclicals when they're cheap. In 2008, I held significant positions in consumer staples businesses, Coca-Cola, Procter & Gamble. These companies didn't stop generating cash just because the economy was terrible. People were still drinking Coke. They were still buying Tide and Gillette razors. The earnings were stable. The dividends kept coming. That stability was crucial. It meant I didn't have to worry about my entire portfolio. I could watch the defensive positions churn out cash while I used new money to buy beaten down cyclicals. Without that balance, I might have panicked. If everything I owned was falling 40% simultaneously, the psychological pressure would have been enormous. The diversification into defensive sectors gave me the mental freedom to be aggressive where aggression made sense. Strategy number 6, obsess over balance sheets. Companies with high debt die in recessions. It's not complicated. It's not subtle. It's mathematical certainty. Here's the mechanism. Debt requires regular payments regardless of business conditions. When revenues fall during recessions, companies with high debt face a choice: make the debt payment or invest in the business. Often they can't do both. Sometimes they can't do either. The negative consequence without attention to balance sheets is simple. You invest in a company that goes bankrupt. Doesn't matter how good the business is. Doesn't matter how cheap the stock got. If the company can't service its debt, equity holders get wiped out. Here are the specific metrics I watch. First, debt to equity ratio. I want to see companies with less debt than equity. Ideally, much less. A 2-to-1 debt to equity ratio makes me nervous. A 1-to-1 ratio is okay if the business has stable cash flows. Less than 1-to-1 is ideal. Second, interest coverage. Can the company's operating earnings cover its interest payments by at least 3 to 5 times? If earnings are $1 million and interest payments are $900,000, that's terrifying. No margin for error. Third, cash on the balance sheet. How much actual cash does the company have? Not accounts receivable that might get paid, not inventory that might sell. Actual cash. Companies with strong cash positions can weather storms. Let me give you a personal application story. In 2008, I was looking at banks. Every bank stock was cheap, falling every day. But there was a crucial difference between banks. JP Morgan Chase had a fortress balance sheet, strong capital ratios, plenty of liquidity, conservative lending standards relative to peers. When I looked at their books, I could see they would survive. Washington Mutual, Lehman Brothers, weak balance sheets, high leverage, lots of questionable assets. They looked cheap on price to book value, but book value was a fiction when the assets were worthless. I bought JP Morgan. I avoided the weak banks. JP Morgan is still thriving. The weak banks are gone. Critics at the time said I was being too conservative. All banks are cheap. They said, you're leaving money on the table by being picky. But the payoff for focusing on balance sheets was survival. And in recessions, survival comes first. Profits come second. The principle: a good business with a bad balance sheet is a bad investment. A mediocre business with a great balance sheet might survive long enough to become a good investment. Strategy number 7, and this might be the most important. Think in decades, not days. Recessions are temporary, always. The longest recession in modern history was the Great Depression, and even that ended. Most recessions last 12 to 18 months. Some are shorter, none are permanent. But long-term economic growth is the dominant trend. Over decades, the economy grows, productivity increases, innovation creates new value. Population expands. That's not optimism. That's history. Here's the mechanism. Stocks are not pieces of paper to trade. They're ownership in businesses. If you own a piece of a wonderful business, your success is tied to that business's ability to create value over time. Think of it this way. If you owned a private business, would you sell it because the economy entered recession? Would you panic and liquidate because this year's earnings fell 20%? Of course not. You'd keep running the business. You'd adjust to conditions. You'd wait for the recovery. You'd think about where the business would be in 5 or 10 years. But somehow, when people buy stocks, they forget they own businesses. They think they own tickers that bounce around. They react to every wiggle in price. I've held Coca-Cola stock since 1988, 37 years as of now. In that time, we've had multiple recessions. The dot-com bust, 9/11, the financial crisis, COVID. Each time, Coca-Cola's stock fell, sometimes significantly. Did I sell? No. Why would I? People were still drinking Coke. The business kept generating cash. The dividend kept growing. I knew that in 10, 20, 30 years, Coca-Cola would be worth more, not less. That's the multi-decade example. The company faced every kind of crisis: wars, recessions, new competitors, health scares about sugar. None of it mattered to the long-term trajectory. Benjamin Graham had a wonderful way of describing this. He said, the market is a voting machine in the short run, but a weighing machine in the long run. In the short run, prices reflect popularity, emotion, momentum. In the long run, prices reflect actual value creation. If you think long term, you can ignore the voting. You just focus on the weighing. Here's the payoff. Long-term thinking eliminates probably 90% of investment mistakes. You don't panic sell. You don't chase fads. You don't trade in and out constantly, racking up taxes and fees. You simply buy good businesses and let time work for you. The warning, short-term thinking guarantees mediocre results. You'll always be reacting to news. Always be worried about the next quarter. Always be tempted to sell when you should hold. Strategy number 8, live simply. This seems unrelated to investing, but it's foundational. If you spend everything you earn, you cannot save. If you cannot save, you cannot invest. If you cannot invest, you cannot build wealth. And if you haven't built wealth before a recession, you cannot take advantage of it. The mechanism is straightforward. Living below your means creates a gap between income and expenses. That gap becomes savings. Those savings become investments. Those investments compound over time. Without this discipline, you're always broke. I don't care how much you earn. If you spend 110% of your income, you're broke. If you earn $50,000 and spend $40,000, you're building wealth. If you earn $500,000 and spend $600,000, you're going backwards. I've lived in the same house since 1958. It cost $31,500. It's a nice house. It's comfortable. It's in a good neighborhood, but it's not a mansion. It's not keeping up with anyone. It's just a house. I drive a regular car. I don't own a yacht. I don't have 8 homes around the world. I don't wear expensive watches or designer clothes. Not because I can't afford these things, because they don't make me happy, and they would prevent me from doing what does make me happy, which is compound capital. Here's the lifestyle inflation warning. Most people increase their spending every time their income increases. They get a raise, they buy a bigger house, they get a bonus, they buy a fancier car. The gap between income and expenses never widens. Sometimes it narrows. True wealth comes from resisting this urge. When your income increases, keep your expenses stable. Let the gap widen. That's how you build resources to deploy during recessions. The principle, wealth is not about how much you earn. It's about how much you keep and invest. Strategy number 9, consume information wisely. You need to stay informed about the economy and markets. You need to understand what's happening. But there's a massive difference between being informed and being obsessed. Here's the mechanism. Media companies profit from your attention. Fear drives attention better than anything else. So they're incentivized to make everything sound catastrophic. If you consume financial media constantly, you'll think every day is a crisis. That constant exposure distorts your judgment. You start seeing patterns that don't exist. You start reacting to noise instead of signal. You make emotional decisions based on headlines designed to provoke emotion. My personal system is simple. I read annual reports. I read business periodicals weekly, not daily. I largely ignore 24-hour financial television. I don't check stock prices compulsively. When I want to understand what's happening in the economy, I look at data, employment numbers, GDP growth, corporate earnings. These are facts. They change slowly. They give you the real picture. Headlines about what might happen, about what experts predict, about short-term volatility, that's noise. It's designed to get clicks, not to inform decisions. Here's a concrete example. During the dot-com bubble in the late 90s, I was criticized constantly for not buying technology stocks. Every day there were articles about how I was missing out, how I was out of touch, how the world had changed, and I didn't understand. I ignored it. I didn't understand most technology businesses well enough to value them. I couldn't see how companies with no earnings and no path to profitability were worth billions. So I didn't buy them. The media made me look stupid for years. Then the bubble burst. Suddenly the same media praised my discipline. The payoff for controlling information consumption, mental clarity. You make decisions based on analysis, not fear. You act when action is warranted, not when headlines tell you to panic. Let me expand on that dot-com example because it illustrates the point perfectly. In 1999 and 2000, I was getting destroyed in the media. Berkshire stock was down, the S&P 500 was up. Technology stocks were doubling and tripling. Everyone was making money, except the old man who didn't get it. Barron's ran a cover story titled, "What's Wrong, Warren?" The implication was clear. I'd lost my touch. The world had changed. My methods were obsolete. If I'd been obsessed with media coverage, if I'd been watching CNBC every day, if I'd been reading every analyst report, the pressure to change course would have been overwhelming. Everyone was saying I was wrong. But I wasn't watching CNBC. I wasn't reading every article. I was reading balance sheets. I was analyzing businesses. And what I saw was companies valued at prices that made no mathematical sense. So I held steady. I kept buying things I understood at prices I could justify. I looked boring and outdated. Then March of 2000 happened. The NASDAQ peaked and began falling. By October of 2002, it was down 78% from its peak. Companies worth billions went to zero. Fortunes evaporated. And suddenly the same media that criticized me was asking how I knew to avoid the bubble. I didn't know. I just stuck to principles that had worked for 50 years. I didn't let media noise override analysis. That's the power of controlling information consumption. Strategy number 10, master the distinction between price and value. Price is what you pay, value is what you get. They're not the same thing. In fact, they're often completely disconnected, especially during recessions. Here's the reframe. Most people think price and value move together. Stock goes up, it's worth more. Stock goes down, it's worth less. But that's confusing. The measuring stick with the thing being measured. The correct definition, value is the sum of all future cash flows a business will generate, discounted back to the present. That doesn't change just because the stock price changes. If a business was going to generate $1 million a year for the next 30 years, it's still going to generate $1 million a year, whether the stock is at $50 or $30. Multiple examples. Imagine a business that earns $1 million a year consistently. The stock trades at $100 per share. Then a recession hits and the stock falls to $60 per share. Has the value changed? Only if you think the recession will permanently impair earnings. If the business will still earn $1 million after the recession, then the value hasn't changed. Only the price changed. And that gap between the falling price and the stable value, that's opportunity. Example 2. Imagine 2 companies. Company A earns $10 per share and trades at $200. Company B earns $10 per share and trades at $80. Same earnings, different prices. Why? Maybe one is growing faster. Maybe one has better management. Maybe one just happens to be popular. The point is you have to understand the underlying value, independent of the price. You can't just buy the cheaper stock and assume it's the better deal. Why does this difference matter? Because recessions widen the gap between price and value. Panic selling drives prices down, regardless of whether value has changed. That creates opportunities for people who can tell the difference. The before and after contrast. Before you understand price versus value, you think falling prices means something is wrong with the business. After you understand it, you recognize that falling prices often mean nothing more than fear in the market. The clear criteria to assess value, you need to understand the business deeply. You need to know its competitive position, its economics, its growth potential, its risks. You need to be able to estimate future cash flows with some confidence. If you can't do that analysis, you can't distinguish price from value. You're just gambling on price movements. Strategy number 11, know your ultimate goal. This is not about panic selling. It's the opposite. It's about having a clear purpose for your investment so you don't panic sell. Here's the context. Most people invest without a specific goal. They're just trying to make money. But make money isn't a goal. It's a means to an end. What's the end? Is it retirement? Is it your children's education? Is it financial independence? Is it leaving a legacy? The answer matters because it determines how you should invest and when you should access your gains. The mechanism, when you have a clear goal, you can ignore short-term volatility. If you're investing for retirement in 30 years, a recession in year 5 is irrelevant. You're not touching that money for another 25 years. Who cares what it's worth today? But if you don't have a goal, every market drop feels threatening. You don't know if you should sell or hold because you don't know what you're holding for. Here's my personal approach. I know exactly what I'm building toward. I want Berkshire Hathaway to compound value for decades after I'm gone. That's the goal. It means I never think about selling businesses we own. I'm not building a portfolio to liquidate. I'm building a portfolio to hold forever. For individual investors, the goal might be different. Maybe you need to fund retirement in 15 years. Okay, that means you can be aggressive for the next 10 years. Then start gradually moving to more conservative positions in years 11 through 15. Or maybe you're investing to pay for a child's college in 8 years. Different timeline, different strategy. The critics might say this contradicts the think long-term advice. It doesn't. Long-term thinking means not panicking during short-term volatility. Having a goal means knowing when you'll actually need to access the money so you can structure things appropriately. The payoff, goal-based investing creates discipline. You buy according to your timeline. You hold according to your timeline. You access gains according to your timeline. The market's daily gyrations become irrelevant noise. Strategy number 12, perfect is the enemy of good. You cannot time the exact bottom of a recession. No one can. Anyone who tells you they can is lying or deluded. Here's the absolute language. It is impossible to know when recessions start or end in real time. The official declarations come months after the fact. By the time economists declare a recession over, the market has usually already recovered significantly. The destruction mechanism of trying to time bottoms, you wait for the perfect entry point. Prices fall, but you wait for them to fall more. they do fall more. You wait for confirmation that the bottom is in. By the time you get confirmation, prices have already rebounded 20 or 30%. You were right that there would be opportunity. You were wrong to wait for certainty. And waiting for certainty cost you most of the gains. Here's the protection rule. Start buying when things are clearly bad, not when they're perfect, when they're bad. If unemployment is rising, corporate earnings are falling, and prices are down 20 to 30% from recent highs, start buying. Not all at once. Use averaging in. Buy a position. If prices fall further, buy more. If they fall even further, buy even more. This approach means you'll never buy at the absolute bottom. You'll buy too early sometimes. But that's okay. Buying great businesses at good prices is more important than buying them at perfect prices. Let me give you a specific example. In 2008, I started buying in September and October. The market kept falling. The actual bottom was March 2009. So I bought too early by about 6 months. Did that hurt my returns? A little. But if I'd waited for proof that the bottom was in, I would have missed the entire rally from March 2009 onward. The market went up 69% from the March low by year end. Trying to perfectly time that would have been impossible. Better to be early and accumulate more as prices fall than to wait for certainty and miss the opportunity entirely. The payoff, you capture most of the gains without needing to be perfect. And investing is not about perfection. It's about good decisions repeated consistently. The principle, buy when there's blood in the streets, even if it's your own blood. Don't wait for the all clear signal. By then, it's too late. Strategy number 13, study past recessions obsessively. Each recession differs in details, but the principles carry across. Understanding what happened before prepares you for what will happen next. Here's the mechanism. Recessions feel unique while you're experiencing them. The 2008 crisis felt like the end of the financial system. The COVID crash felt unprecedented because it was driven by a pandemic. The dot-com bust felt like the death of an entire sector. But when you study history, you see the pattern. Panic, capitulation, recovery, growth. Always. Every single time. The specific trigger changes. The psychological cycle does not. Let me walk through the major recessions and what you should learn from each. The Great Depression, 1929 to 1939. Worst case scenario, 89% decline, lasted a decade. What's the lesson? Even in the worst crisis in modern history, businesses survived and thrived. Coca-Cola paid dividends throughout the Depression. Procter & Gamble grew. The economy eventually recovered. The 1970s, stagflation, high inflation, combined with recession. Difficult environment. But businesses with pricing power protected shareholders. Energy companies did well. Real assets held value. The lesson, not all recessions are deflationary. Sometimes you need to protect against inflation. The 1987 crash. One day, 22% drop. Felt like the end of the world. Market recovered completely within 2 years. Lesson sudden. Severe drops are usually temporary. The 2000 dot-com bust, speculative excess, followed by 3-year bear market. NASDAQ fell 78%, but the S&P 500 only fell about 49%. The lesson, bubbles in one sector don't necessarily destroy everything. Quality businesses in other sectors can hold up. The 2008 financial crisis, systemic crisis, banking collapse, credit freeze, felt like another depression. Market fell 57%. Recovered all losses within 4 years. lesson, even when the financial system itself is in crisis, the economy adapts and recovers. Context matters enormously. You need to understand whether a recession is deflationary like 2008 or inflationary like the 1970s. You need to know if it's driven by financial excess or external shocks. You need to recognize whether it's a normal recession or something more severe. But the overarching lesson from all of them, recessions end, markets recover, good businesses survive, patient investors profit. Let me tell you about 1974, because it taught me crucial lessons. The market fell nearly 50% from peak to trough. Inflation was raging. Oil prices had quadrupled. There was talk of the U.S. economy entering permanent decline. Pessimism was everywhere. I'd been investing for over 20 years at that point. I'd seen difficult markets before. But 1974 tested my conviction like nothing prior. The businesses I owned were trading at prices that seemed absurd. Wonderful companies selling for less than their working capital, less than the cash in their bank accounts, minus all liabilities. A lot of investors I respected got shaken out. They sold because they couldn't take the pain anymore. They couldn't see how it would get better. But I'd studied the 1930s. I knew that even in the Depression, recovery eventually came. I knew that quality businesses bought at cheap prices had always worked out over time. So I bought more. I deployed every dollar I could. I felt like a kid in a candy store, not because I was happy about the recession people were suffering, but because the opportunities were extraordinary. Those investments became some of the best I ever made. See's Candies, which we bought in 1972, just before the crash, looked like a mistake for a while. But over the following decades, it generated hundreds of millions in cash that we deployed elsewhere. The lesson, when you've studied history, when you know the pattern, you can act when others are paralyzed. Strategy 14, cultivate courage. You can have cash. You can have your list. You can understand psychology and balance sheets and value. But if you don't act when the moment comes, none of it matters. Here's what I observe. Most people freeze despite having the right plan. They know intellectually what they should do. Buy when others are fearful. But when fear is actually thick in the air, when every instinct screams danger, they cannot execute. The mechanism is purely psychological. Acting during maximum fear requires overriding your evolutionary programming. Your brain is trying to keep you safe. It interprets everyone else's panic as a signal of real danger. Fighting that signal is hard. You must practice mental scenarios to build courage. Visualize what it will feel like when markets are falling every day, when news is uniformly terrible, when smart people are telling you to get out. Visualize yourself buying anyway. This is like athletes visualizing performance. They see themselves making the shot, executing the play, succeeding under pressure. That mental rehearsal builds neural pathways that make actual performance easier. You need to do the same with investing. See yourself clicking the buy button when your stomach is churning. See yourself deploying cash when your friends think you're crazy. See yourself staying calm when others panic. Without this mental preparation, courage fails. And courage is what differentiates those who profit from recessions versus those who merely survive them. Here's my personal example. In 2008, I had to convince my own team to make some of the investments. These were smart, experienced people. They understood the analysis, but they were scared. The fear was that powerful. I had to lead. I had to show conviction. I had to act first and trust that the logic would prove correct eventually. That wasn't reckless bravery. That was prepared courage. I'd thought through the scenarios. I'd studied history. I knew what I was buying and why. When the moment came, I was ready to act. The payoff: courage under pressure creates wealth. Not luck, not genius, courage. The ability to do what you know is right when it feels wrong. Strategy 15, the final strategy: cultivate extreme patience. Investments bought during recessions will not rise immediately. You need to accept that. Embrace it even. Here's the extended metaphor: planting an oak tree. You dig the hole. You plant the acorn. You water it. You wait. Nothing visible happens for months. Then a tiny shoot appears. You wait more. Years pass. The shoot becomes a sapling. More years. The sapling becomes a small tree. Decades pass. Now you have a magnificent oak. If you planted the acorn expecting a tree in 6 months, you'd be disappointed. You'd dig it up, plant something else, repeat the cycle, never getting results. But if you understood from the beginning that oak trees take decades to mature, you'd plant and wait patiently. That patience is what creates the result. Recession investing is the same. You buy in 2008, the market doesn't recover for months. It makes new lows in March 2009. Stays volatile through 2010. Gradually climbs in 2011 and 2012. By 2013, you're clearly ahead. By 2015, you're doing very well. By 2020, you've made multiples on your investment. But that journey took 12 years. 12 years of holding through volatility, uncertainty, and doubt. Most investors can't do that. They buy during the recession, then sell in the early recovery when it's not working fast enough. They miss the compounding that happens in years 5 through 15. The multi-decade example: if you bought the S&P 500 in March 2009 at the absolute bottom and held for 15 years until March 2024, you made approximately 500%. That's spectacular. But to capture that, you had to sit through the European debt crisis in 2011, the taper tantrum in 2013, the energy crash in 2015, Brexit in 2016, the trade war in 2018 and 2019, COVID in 2020, inflation fears in 2021 and 2022. Every single one of those events tempted you to sell. If you sold during any of them, you missed the full compounding. Patience isn't passive. It's active discipline. It's the daily choice to stay the course despite noise. The payoff: patient investors capture the full power of compounding. Impatient investors capture a fraction of it. As I've said many times, and this bears repeating, the stock market is a device for transferring money from the impatient to the patient. So let me bring this all together. Recessions are coming. Not maybe. Certainly, you will experience multiple recessions in your investing lifetime. That's not pessimism. That's the economic cycle functioning as it always has. You have a choice in how you approach them. You can do what most people do: panic when prices fall, sell when fear peaks, hide in cash or bonds, watch from the sidelines as opportunities pass, slowly recover as markets rebound, repeat the cycle next recession. That path keeps you stuck. You never get ahead. You're always reacting, never positioning. Or you can prepare. You can build cash reserves now. You can make your shopping list. You can study businesses. You can train your psychology. You can avoid leverage. You can live below your means. You can understand value. You can learn from history. Then, when recession comes, you act. While others panic, you deploy capital. While others sell, you buy. While others freeze, you execute. The negative consequences of the panic path are clear. you miss the greatest wealth building opportunities of your lifetime. You spend decades investing but never build significant wealth. You're always one recession away from fear-based decisions. The positive benefits of the preparation path are transformative. You build wealth during downturns. You compound that wealth during recoveries. You enter each recession stronger than the last over a lifetime. You separate yourself from the crowd completely. Let me recap the rapid actions. Build cash reserves today, not when recession starts. Make your shopping list this week. Study the businesses you want to own. Master your emotional responses through practice. Eliminate leverage completely. Create smart diversification. Analyze balance sheets of potential investments. Adopt a decades-long time horizon. Reduce your expenses and increase savings. Control information, consumption. Understand value independent of price. Define your investment goals clearly. Accept that you cannot time bottoms perfectly. Study every past recession you can. Rehearse courageous action mentally. Commit to patient holding. Here's my credibility marker. I've been doing this for over 7 decades. I've seen 11 recessions. I've invested through every kind of market condition imaginable. The strategies I've shared are not theoretical. They're battle-tested. They work. But I won't see many more recessions. I'm in my mid-90s now. At best, maybe 1 or 2 more. But you, if you're young, you'll see 10 or 15 recessions. Each one is an opportunity. Each one can accelerate your wealth building if you're prepared. This is the torch passing moment. I'm giving you the playbook, not because you'll do exactly what I did. Circumstances change, businesses change, but because the principles don't change. Human nature doesn't change. Fear and greed don't change. The cycle doesn't change. What you do with this information is up to you. You can file it away and forget about it. You can intellectually agree but never implement. Or you can take it seriously. You can prepare. You can position yourself to thrive. The next recession is coming. I don't know when. Could be next year. Could be 5 years from now. Doesn't matter. What matters is that you'll be ready when it arrives. Because recessions don't destroy prepared investors. They reveal them. They transfer wealth from those who hope for the best to those who prepared for the worst. Be in the second group. Start today. That's the opportunity. That's the choice. That's the path to building real, lasting wealth. The rest is up to you.